Welcome back. You're watching Stock Watch with me, Zanathi Goma, and joining me to take your stock-related questions tonight are Jean Pierre Verster from Protea Capital Management and Ricus from PSG Hole-in-One Ruimsig. Be sure to send your questions on email at stockwatch@bdtv.co.za or via SMS on 41392 or on X using the hashtag StockWatch. Thanks so much for your time, gentlemen. Let's get straight into it because there are lots of questions also coming in from yesterday. So the first one that I have for you is Amplats. Can you explain the rise in Amplats share price? What are the contributing factors? Of course, the rise that was before yesterday and today's fall, but seeming that it's little compared to the rise that we had seen for the last at least week or so. And JP, would it all point to the results that were better than expected that Amplats came out with?
Yes, Zanathi, I think to a certain extent, the share price reacted positively. So the results were, as you said, slightly above expectation. I think also the comments that Amplats will look for a London listing calmed some people that thought that after the unbundling, there'll be a bunch of Anglo-American shareholders who said, why do we own this little piece of a company on the southern tip of Africa when we are basically invested in a London share, Anglo-American, and they would just throw away the Anglo Platinum shares at any price because they weren't able to hold them if the mandate did not allow them to hold shares in South Africa. So that was also addressed. And then finally, if you look at the PGM price, the basket, mostly platinum, palladium, but also rhodium, that has come down a lot over the last, 3 years or so, since we had a bubble in rhodium prices. But for the last, 6 months or so, it's sort of gone sideways, the PGM basket price. So I think people are looking, any little bump in the PGM price, people get excited and think the next rise in the PGMs will be around the corner. That'll be very good for the likes of Amplats. And then they buy the share, but that's happened a few times the last 6 months. And then the PGM price falls, and then the Amplats and Implat and Northern Platinum share price falls as well. So it's been mostly sideways the last 6 months because of that dynamic.
Right. Well, I mean, Ricus, with the fact that, that kind of overhang of Anglo letting go of Amplats that's kind of dissipated here, and having these earnings that came out better than expected, would you say that right now when looking at Amplats, you can purely just look at that PGM market and basically it's up to how you are reading into what is going to happen in the short to medium term that should determine whether you should have an appetite for it or not?
Yeah, I think you're right, Zanathi. Fundamentally, they're probably in a better position than Implats as far as reserves and staying power is concerned. I don't think as good as Northern Platinum, but that whole sector is under pressure and will only react when we get demand back for platinum and platinum group metals. At the moment, I can't really see that happening in the short term. So we might be in a base building position as far as their share prices are concerned. But in my personal opinion, I don't have any appetite for Amplats or any of the other shares in that sector at the moment. And as JP has said, there's been some movement as a result of corporate actions. Their results were better than expected, mainly because they were selling from stockpile. That's a once-off event. But yes, I think just putting it all together, no appetite for that sector. And I think the enthusiasm surrounding the corporate action in Amplats is probably dissipating.
All right. Well, quite interesting that, because you say that Amplats should be better off than Implats, because there is a question on Implats. JP, your view on Implats?
Very similar. I would say that the Amplats is lower down on the cost curve. So that means that the cost to mine PGM metals are lower. So it means that if the price is low and depressed like it is now, Amplats is in a more defensive position because their costs are lower. But the interesting thing is that if you should get a spike in the PGM price, it would benefit the more marginal producer, the producer higher up on the cost curve more. Because the difference would be much higher from a low to a high PGM price to that producer of the metal. So it depends on your PGM outlook. If you think PGM prices could be under pressure for the medium to long term, then Amplats is the better one. If you think there could be a strong recovery in the PGM prices, and then you might go for Implats because it's more geared to the price because they are higher up on the cost curve.
All right. Well, there's a question on Absa. What's wrong with Absa? Because there was a big drop yesterday, and the question goes, is there a management problem? Ricus?
Looks like it. I mean, if you compare them to the other banks and the rumblings in the boardroom, and also their strategy over the past few years, where they've really lost the race as far as technology is concerned, and it shows up in the share price, plus the exposure to a difficult part of the market, which is housing.
It's actually quite interesting because Absa, I mean, as much, there has been obviously optimism for the whole banking sector, but I mean, Absa, because it's underperformed, a lot of people saying that it looks cheap. A lot of people are going for it. Even yesterday, I had a technical analysis with Pietri Redelinges, and he actually was saying that he is going long on Absa, short on FirstRand. JP, what would your kind of, movement with Absa look like at this point? Would you be buying? Would you be shorting? And what exactly do you think the problem is with this underperformance?
So there does seem to be some issues at the senior management level. I mean, there was an article in the Sunday Times, and then Absa came out and said it was malicious and sensationalist, and to some extent it probably was. But clearly between the board, the executive team, and then just below the executive team, there's it's not a happy household at the moment. And people speaking out to journalists, and it's not pleasant. So hopefully they can sort that out. Factually, Absa is the cheapest bank relative to the balance sheet, to net assets, to earnings, the highest dividend yield. But just because something is the cheapest doesn't mean it necessarily offers the most value. And what we've seen in the banking sector, but actually this goes for most companies, is that quality of management and long-term capital allocation drives the relative share price return. So in a sector like the banking sector, the management team that allocates capital the best into the highest yielding business lines, the share price will follow and also do the best. And therefore, between those two you mentioned, I prefer FirstRand because they do have the better capital allocation history, track record, and the higher returns, both return on assets as well as other elements you can look at when you look at banks. So between the two, even though Absa is the cheapest, I think FirstRand offers the best value.
Well, Ricus, where would you be looking for more value there in the banking sector?
Well, I agree with JP, and I'm also just talking my book, and my preferred choice is FirstRand, but I can also see where Peter Redelinges is coming from. Absa is just about hopefully to pop above its 200-day moving average to the upside. So if management gets better, in other words, if there's a slight turn in fortune, then Absa's got a lot of catch-up to do in the short to medium term, just from a technical basis. But if I want to sleep, if I want to sleep at night, I'd rather be in FirstRand.
All right. Well, there is a very technical question here. JP, I notice that there are JSE-listed instruments called stubs, which provide exposure to long process short 10 cent and long Naspers short 10 cent. The instruments derive value from the shrinking or widening discount between the local stocks and 10 cent. Could the guests offer some insight on how to calculate the respective discounts between Naspers and 10 cent and Process and 10 cent, and if possible, suggest some resources available to retail investors to obtain the info needed for this equation? I'm taking you to maths class right now, JP.
Yes, so what you need to do, Zanati, is you need to look at the market cap of whether it's Naspers or Process. Then you need to look at what is the value of the investment in 10 cent in the same currency. And then you can work out the discount. by saying, what is the value of the 10-cent stake divided by the market cap of the company you're comparing it to? Now, the tricky thing is that these companies are busy with share buybacks. And Naspers and Prosus are funding part of the share buyback by Prosus selling 10-cent shares in Hong Kong. So it's not easy to work out the stake day by day of the value of Prosus's stake in 10-cent. But thankfully, there's a solution. And the solution is the investor relations webpage of Naspers and Prosus. So you can just Google, and every day they update the investor relations page for the latest NAV, net asset value per share, for both Prosus and Naspers. And in that calculation, they also have a line which tells you the value of the 10-cent stake. So you can just use that to then take the 10-cent stake divided by the total market value of Naspers or Prosus. That'll give you the discount, and that will make you decide if you want to buy the stub. As a final word of caution, I'll just say that that stub can be very volatile, which means it can drop a lot. And it drops a lot normally when 10-cent does very well. And 10-cent has not been doing well for a long time. I see some value in 10-cent. So if 10-cent does well from this point forward, chances are the discount will widen, and that'll be bad if you bought the stub.
Okay. I mean, yeah, would you be going for the stub, or do you just go for the companies directly?
I've played in the stub before, and I burnt my fingers a little bit, thankfully not too much. So I prefer to hold Naspers directly, and in our global funds, we hold 10-cent directly.
Yeah. Anything to add there, Ricus?
JP is far more versed in this subject than I am, but I would imagine, and JP can correct me if I'm wrong, but apart from just the discount or premium, I think the volatility in the various share prices also comes into effect, because, in effect, we are talking about a discount, both real in terms of market cap, but that's also going to be influenced by how the underlying instruments, in other words, Naspers, Prosus, and 10-cent, what kind of price movements one can expect from them using historical data, how volatile those share prices is, and how quickly those discounts or premiums closes and opens. So apart from just the normal mechanics of how much each of these instruments hold of each other, you've also got to consider how volatile these prices are.
All right. Well, thank you for that educational segment, gents. There's a very interesting question here. I sold my Copper 360 and bought Sun International. Does the panel think that this was a good idea? Quite interesting. From Copper 360 into Sun International. Ricus, do you think this was a good idea or a bad one?
I don't know. It really depends on the questioner's risk appetite. I mean, Copper 360 is in effect an exploration or a developing mining company. Now you're going into Sun International, which is hospitality and gambling. So it's two completely different type of operations. So I can't say whether it's good or bad. I mean, because you would have different reasons for holding either of these two. They are just so disparate, or so different in what they do that I can't really say whether one is worse than the other, because I can't compare the two.
Yeah. And it's quite interesting because a lot of analysts just rather look at Copper 360 from a distance because of what Ricus said, that it is an exploration company. So I'd imagine that actually a lot of analysts would think, okay, yeah, Sun International, sure. JP, would this be the direction that you're going in?
Well, Zanati, when one goes to the casino, do you prefer to play the machine, or you prefer to be the owner of the machine? So if you like to play the machine, which means you'll probably lose, but there's a small chance you'll make a lot of money, then you probably want to buy the exploration company. While if you want to be reasonably certain you'll make money, then you rather want to own the machine. And that is what Sun International does. So generally, I prefer to own the businesses that already generate cash. But if you want to buy a lottery ticket or play the machine, and maybe you can get a 777, then you can buy something like Copper 360.
Yeah, well, sticking to the tourism space, what do you think of City Lodge? I've always thought their numbers look good, their management too, their price undervalued. And yesterday, I actually didn't check today, but yesterday was a good day in the market. What does the panel think? City Lodge, Ricus.
I saw some tourism numbers earlier today, and there's certainly, what should I say, the return to normality of specifically overseas tourists are continuing. So that's good news, not only for Southern Sun, but for the likes of City Lodge, for example. Obviously, the local market is still under heavy pressure. We all know why. Nobody's got money. So we really do need an increase in local expenditure on that kind of leisure, and a continuation of an influx of investors from overseas. So it is a sector that's loaded with potential, but does need really better economic growth locally. And as I've said, political stability, which will make people keener to come and visit from overseas for that sector, whether it be City Lodge, National, Toga Sun, or Southern Sun, to really catch fire. So I think it's a firm hold in my book. Okay. For all of those, but we haven't yet got that excitement going in the sector.
Yeah. Well, actually, I mean, as the viewer says, the numbers look good, management too, and tourism is continuing, as we saw today out of Stats SA. JP, is there anything to be cautious of in terms of City Lodge?
Well, the one thing to be a little bit cautious on is business travel. So a lot of the people who stay at the City Lodge are not necessarily tourists, but business people who travel from one city to the next, and it's too far to drive back or too late to fly back home, so they stay over an evening or two at the City Lodge. And, you know, it's like this, Zanati. I'm not sitting there in the studio with you. We're doing this meeting, this show over Zoom.
Yeah.
So similarly, a lot of business has moved to having meetings electronically over video conference rather than physically. So there's less people moving around for business, and therefore less people needing to sleep over at their local City Lodge. So yes, it's a solid business. It's a good management team. They obviously had the disaster just over COVID with a lot of debt. They got triggered because the share price went lower, and the company basically guaranteed that debt. But you need an uptick of business travel rather than just tourism before City Lodge will really do well, I believe.
All right. Well, let's get to Combined Motor Holdings. Is Combined Motor Holdings with a dividend yield of 13.3% and a PE of 5, a good buy, Ricus?
Yeah, it's not a company I keep track of all that well. I had a quick price comparison, share price comparison with something like Supergroup, and they're basically doing the same price-wise. So as a not a real insight into the company itself, but as to the market itself, it's selling cars. They're getting a lot of competition from your cheaper Chinese, Korean, Indian imports, I would imagine. And so there's a lot of competition in that market at the moment, and we've just I've just spoken about leisure and the cash in pocket as far as people are concerned, which will affect your vehicle market. So yeah, don't really have an opinion, and there's nothing in the share price that excites me.
Yeah, and actually we really haven't had any exciting numbers coming out from the vehicle sales data that we've gotten this year. JP, how would you be looking at CMH?
Yeah, I agree with what has been said, and you saw in the last results for CMH that their profits from vehicle retailing shrunk, but then the profits from the vehicle rental, from first car rental, improved, and that offset the shrinking profits from the vehicle retail. So I really like CMH. I think it's a great small cap. Yes, the price, if you just look at the price, is similar to the likes of Zeda or Motus or Supergroup. But if you put the 13% dividend yield on top of that, then it has significantly outperformed the others over the last 3 to 5 years. So it's my preferred stock in the car rental / car retail market of the 3 or 4 companies I've mentioned. Very good management team that also owns a significant stake, more than a third of the business. And it is very, very cheap. I think the fair value of CMH is double the current share price. But we've seen on the JSE, it often happens that smaller companies and small cap stocks not only are very cheap, but stay very cheap for a long time. The benefit with CMH is while you wait, you get a 13% yield.
All right. Gents, I quickly want to go into, before we get to your stock picks, a question that just came in on Quilter. Your view on Quilter, Ricus?
I like it. It's results over the past 6-12 months have been pleasing. They're an asset management business that also sells what they sells a product. It's very much like us, PSG Consult. So a good management team on the one side and a very good distribution network, and it shows in their results. I like the fact that the domicile in the UK, because I think strangely enough, in that part of the world, in other words, Europe, UK is looking all of a sudden, or the UK market is looking far more positive than France and Germany, for example. And yeah, if sentiment towards the UK market improves, it will affect something like Quilter as well, whether the company's results are good or bad or indifferent.
Okay. Would you be as optimistic on Quilter, JP?
Yeah, it's okay. I think they've got the flywheel going to get the assets on the platform and keep the assets on the platform and get their advice fee. So it's a decent model, but the share price is up probably 50% over the last year. So a year ago, there was some value. I think it's much closer to fair value at the moment.
All right. I think I do have, I can sneak in one more question. Richmont. Yes, okay. My director is telling me to hurry it up. Richmont, I'm definitely going to hold. I always say my financial advice is Mr. Rupert. Ricus, would you have this much conviction on Richmont?
Well, I don't have it at the moment. I sold a few months ago. I think the luxury market is under pressure. Why? Because of China. There's no consumer spend in China, and it's really struggling. And until that returns, we're not going to, other parts of the world are okay for Richmond, but that other big factor, which is China, is not going to fire, therefore no.
All right. So Ricus took his profits. JP, Richmont at this point.
Yes, the whole luxury space is under pressure. A lot of results came out in the last few weeks, which showed that Hermes is probably doing the best. Product came out earlier today. We'll see the share price reaction tomorrow. They did surprisingly well as well. But the others are going through a soft patch because of China. So on a relative basis, I like Richmont in the luxury goods space. But at the moment, no reason to own exposure to the luxury goods space.
All right. Well, where would you rather have exposure? Ricus, your stock pick for today?
I think it's in the US, and as people might be aware, there's been a huge shift from your mega cap companies into the smaller mid cap value companies. I don't like the fact that people are mentioning value, but there's certainly a shift of funds into the mid to small cap sector. Don't go for value companies in the sector, go for growth companies, because when interest rates are going down, companies which seemingly offer value because of various reasons are probably going to do worse because the income, because it just shows you a slowing market. So go for a growth company in the small cap sector or mid cap sector. One of those is ABM Industrials, listed in New York. And if you think about what they do, think of Bidvest locally. ABM provides services to, whether it be catering or whether it be cleaning your building, that kind of thing, parking lot management, to a huge variety of companies in the US. They've been listed since 1909. They've never dropped their dividend. ROE is looking great, earnings growth looking great. It's a growth company in the mid to small cap sector. I think that's where you've got to concentrate.
Interesting. JP, on your side?
Tonight I'm going for Stellantis. It's one of the top 5 biggest motor vehicle manufacturers. They own brands such as Peugeot, Citroën, Fiat, Chrysler. Alfa Romeo, Jeep, Dodge, Ram, even Maserati, although apparently they're considering to chop that one. And they came out with results recently that were below expectations. The share price has taken a big knock, mostly because they've got too much inventory in the US. They are sitting with too many cars that they haven't sold yet. I do expect the second half will be better, that they'll sell a lot of those cars, and they've spent a lot of money, billions of euros, to invest into electrical cars. The small Fiat that you might remember from the previous James Bond movie, the latest one, has been selling like hotcakes in Europe. So at a PE of roughly 5 times, it's cheaper than any of the other major motor manufacturers. And I think they'll sort out the inventory issues and grow their sales from here, especially because of all the money they've put into EVs and hybrids as well. So Stellantis is my stock pick tonight.
All right. Well, thanks so much for your time and for your analysis today, gents. Much appreciated. That is all for tonight's Stock Watch. Thanks to our guest, Jean Pierre Verster from Protea Capital Management and Ricus from PSG Hole-in-One Ruimsig. Up next, The Close. Stay tuned.